There are many permanent life insurance policies out there that provide good potential for growth. Now, that growth can be used for many different areas, from legacy planning to tax efficiency, all the way to wealth transfer. Now, when it comes down to the type of policy that's right for you, look for ones that have low fees attached to them. Now, what better way to aid in the growth and have potentially more growth than to lower the fees, so you have more for legacy planning, you have more money set aside for wealth transfer, and you have the potential for more money for tax efficiency. All of that comes back down to one category of life insurance that may be right for you, and that is a commission-free permanent policy. Hey, it's Nathan Krampe, and you are likely very ambitious when it comes to your overall financial plan and wealth management. But you know there is more out there. You want to create an impact for yourself, your community, your family, as well as your company. And you get the push to learn something more by learning about great opportunities that you have available in life insurance, specifically life insurance that is commission-free. So let's take a look at commission-free VULs and the benefits they have to you. Enjoy. When it comes to life insurance, there are many different options with respect to permanent as well as temporary life insurance. Now today we want to be talking about the permanent policies, and more specifically the variable universal life policies. Now, this type of insurance is one where the life insurance value, or the amount that is in the cash value, is growing and can be invested. It can be invested into a fixed account that is growing at a fixed rate year over year, or it could actually be invested into the stock market or the bond market. And the funds that are there provide the opportunities for that growth. Now, this opportunity allows for flexibility. Flexibility in your premium payments, as well as flexibility and adjustability of the overall investments as well. So the benefits to you is that we can actually be increasing the death benefit over time with one that can be growing with the stock market, or we can actually have a level premium policy as well. So that's something that is out there as well. But when it comes back down to that cash value that is in the policy itself, that performance, the value, the growth of that can be variable with the stock market. So if we take on a little bit more risk, we can have the potential for greater rewards. Likewise, if we consider more of the fixed type of an account, we can also have a known amount of growth in the policy. But the VUL, or the variable universal life, offers that flexibility and the opportunity for the growth that traditional life insurance policies don't in the same and similar manners. But the insurance comes with, well, more fees associated with that. And that's what we're going to be talking about, how to reduce those fees and why that's important to you. Let's talk about the benefits of the variable universal life, the VUL policy, and how they relate to you. Okay, let's start with the premiums. Premiums are paid into the VUL, and the insurance company itself will deduct their mortality and expenses. So these are the charges that are needed just to basically maintain the policy itself. Now, the remaining amount of money that you've put into the premium, that money is going to be invested. It can be invested into a fixed account that's going to grow at a fixed amount, or it'll be invested into sub-accounts that are going to grow with the stock market as well as the bond market. This invested cash value grows tax deferred until you take withdrawals. Now, the withdrawals in the policy have basically are dependent upon the performance. If the performance is positive, the cash value is credited up to the maximum amount. If the performance is negative, you may actually need to be putting in more in the way of higher premiums in order to cover the cost of the insurance and rebuild that cash value. But here's the part of the withdrawals I want you to understand. It's unlike a variable annuity. You see, the withdrawals from the VUL receive what's called a cost basis, and it's first in, first out, meaning that the total amount of money that you put into the policy and all these contributions to the account can be withdrawn tax-free. Now, it's up to that basis, and once the basis has been depleted, the remaining withdrawals are basically subject to the investment performance, and it will be counted as taxable income. But here's a crucial element of the VUL. Rather than take the withdrawals and have it be a taxable event, you can actually go from the investment performance, and the insurer will allow you as the owner to take a loan against the accumulated cash balance. Now, those loans accrue interest, yes, but is not taxable as income unless the policy lapses. So, in addition, the death benefit paid by a VUL is tax-free in most cases. Now, what that can do is provide a unique tax advantage for not only you, but also your heirs. There are a lot of elements that are positive to you as the owner with VULs, but there are also problems with them, and one is based upon the commission that is paid for these VULs. You see, the commission that's paid goes to the agent for the sale of the VUL policy itself, and it can be a very high expense for the policy, and it is some of the highest in the industry. You see, in some cases, between 70% all the way up to 100% of the first year's premiums can be put into those commissions. So what this means that in the first year, there may likely be either no cash value built or a small amount of cash value built within the policy. And the agent will typically get the rest paid out as form of commission. Now, the agent will receive a smaller commission as well, ongoing, beyond the first year. So this could mean anywhere between 15% all the way up to 25% of the premiums ongoing could be paid as part of a commission. So when we look at commissions, the administration and the expenses can be incredibly high. But if we talk about stripping those commissions out and look at a commission-free annuity, that provides the removal of a lot of those commission elements, and the VUL purchase, that cash value that you have, can grow potentially at a faster rate, and it will give you more of a long-term growth potential. There are a lot of benefits to life insurance, so we want to be diving into more specifically a commission-free VUL and what that means for you and what that means for some of your planning. Let's first talk about your legacy. You see, when we talk about VULs, they become very attractive as an option and an opportunity that you have to provide legacies for not only your family, but also for some of the other needs that you want as well. So it can provide a legacy just for your spouse, for your children, but it can also provide for estate tax concerns you have. You see, the VUL provides a number of tax benefits, not only during your lifetime, but it provides tax-free transfer of assets at your death. Now, this is not available with many other strategies that are out there, and what makes the life insurance, and specifically what we're talking about today, the VULs, a great part of your financial planning. And if we do that in a commission-free way, all the better for the potential growth that you can have and potentially leaving a bigger legacy than you may have thought possible. Let's talk about other benefits you have as well. And let's talk about one that's just very specific to the life insurance itself. You see, you may wish to create a long-term death benefit and lean on your financial advisor to help manage the additional cash value that you have, and it is attractive when it is in the VUL policy. You see, you can actually have what's called market risk associated with that. But if we're growing with the stock market and the bond market over time, that can allow you to purchase a higher amount of death benefits due to the higher potential for growth and returns. Now, that flexibility that the VUL allows you can provide changes to your premiums, so you can actually lower your premiums over time, possibly. You can actually access the cash value, or you can actually change the death benefit amount and the structure. So all of those, just the life insurance itself, provides a lot of flexibility when you're talking about it in elements of the VUL, and specifically the commission-free VULs. And that leads us to our third opportunity with retirement income. You see, commission-free VULs allow for a higher cash value accumulation potential. Now, the opportunities that you have there are due to the lack of commissions that are paid to the agent, as well as the variable structure of the policy itself. You see, the policy is, going back to our tax treatments, a first in, first out, or what we call FIFO treatment. Now, what that means is that the withdrawals that you are taking and creating a potential for a tax advantage flow of income. Now, that cash flow can be critical and very useful for you. And what this is going to allow you to do is take income from the policy and start to look at the better opportunities you have for taking income from other sources that may potentially lower your overall tax situation. In addition to that, if you are under the age 59 and a half, you would have a penalty coming out of your retirement accounts and your qualified accounts. Not the case with variable universal life policies. And that is one of the great benefits from pulling from a policy like this versus some of your retirement accounts earlier on as well. And the last aspect we want to talk about is the wealth accumulation. Now, assets used to purchase a VUL are invested into, again, what we call the sub-accounts that can grow with the stock market and the bond market, and perform similarly to mutual funds. Now, this growth that happens with these assets are tax deferred throughout the life of the policy, and that allows for greater accumulation potential than if you had invested directly into a brokerage account, an individual account, or a jointly held account outside of a retirement kind of envelope in that wrapper. So again, what this can provide is greater benefits for growth, as well as the ability for using that cash value to grow with the stock market. Because you've made it this far in the video, I want to celebrate you. You see, most people start but don't actually finish. Most people don't follow through with the things they say they're going to. They want a better wealth plan, but they don't take the action or do the work. But you're different. You've made it this far, and to show you my gratitude, I'm giving you a special one-on-one consultation to look at your overall wealth plan and look at how the variable universal life policy, especially one that is commission free, can fit into your overall wealth plan. And I do this because you are very important, and to get your wealth plan right is a vital opportunity for you to make an impact that you want with your family, your community, as well as your company. There are many elements when it comes to your overall wealth plan, and I've selected this video just for you. Keep creating an impact, and I look forward to seeing you there.